My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you a little money. My job's not just to entertain, but to educate, to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After big wins, stocks can be very vulnerable. The bigger the win, the greater the vulnerability. And that's what we saw today. It was a tough session for the winners, but not so for the losers. Yep, on a day where the Dow dipped 9 points, S&P advanced 0.1%, and the Nasdaq gained 0.32%, it's astonishing how the great stocks at this very moment mostly got pummeled, while the subpar performers of the last year finally had their day in the sun. Bye, bye, bye. It's uncanny how the former winners are just falling. I mean, like, Royal Caribbean's been a real horse. The cruise line has outshined all of its competitors, rallying from below $80 last October to $138 yesterday. But today it was down 5 points. When I looked it up, all I saw was an unfortunate incident where a 20-year-old man jumped overboard on April 6th, and a 66-year-old man with dementia is missing off a Royal Caribbean excursion in Mexico. As sad as those incidents are, they're the kind of headlines that are inevitable in the cruise line business. I think people are just looking for an excuse to ring the register on what's become a very strong stock. Meanwhile, among the biggest winners today are some major long-term losers. Moderna rallied more than 6%. This is a $111 stock, but that was $158 a year ago. And it's plummeted from its COVID high of $497 in August of 2021. Moderna's got a vaccine that might work against head and neck cancer, and analysts pointed out today, and that's great. But it's still only in very early testing, not something I pin my hopes on. It's their day to do well, though. People can never resist Moderna all the way down. Next loser, how about Cramer all-time fave, Nvidia, down 18 points, and at one point down $40, in large part because of worries about competition, specifically from Intel, which put out a release today talking about a new chip, the Gaudi 3, they claim is vastly superior to Nvidia's H100 super chips. When I read the release first, I gulped until I read the claims that Intel made about its processor, the Gaudi 2, back in 2022. Which also slagged Nvidia's chip as a poor man's Intel. And the Gaudi 2 didn't make any waves at all. I know that if I weren't pretty well versed with Nvidia, I might have been tempted to sell back then in 2022, as the Gaudi announcement made it sound like Intel would own the market that had been previously dominated by Nvidia, because their chip was so much better. The Intel release at the time said the Gaudi 2 had, quote, twice the training throughput of the Nvidia A100, end quote. But if you sold Nvidia that day, how'd you do? You would have gotten $175 for your stock. 175. Well, now it's at 853. Glad I helped. Now, it's entirely possible the Gaudi 3 is superior than the Nvidia H100 in some categories, but the H100 is not what they'll be competing with. By that time that Intel's super chip goes out, Nvidia will be shipping the much faster Blackwell, which was unveiled at their recent GTC conference. Plus, what made me want to stick with Nvidia back then? Simple. It's not just the chip, it's the software, it's the ecosystem, it's the platform, it's the leadership. Consider it like this. Let's say you have a running back that could run a 4.2 in the NFL Combine, but in the real game, it might not cut it at all. On the other hand, a fully loaded NVIDIA running back will have developers writing code for it, a host of already hooked customers, including the mega caps, and the service that's nothing short of unbelievable. You need the blocking and tackling NVIDIA has, and Intel does not. That's why I think the Gaudi 3 will be as lightly used as the Gaudi 2. And I'd rather buy Nvidia than sell it here, even as I predicted that the stock would get crushed with a lot of selling in the wake of GTC. The selling's been pronounced, as the new stock's now sunk more than 100 points. That stock's now sunk more than 100 points in just over 2 weeks. And you know what? If we get a red-hot CPI tomorrow, I think we'll see today's lows again. So I'm not saying buy. Nvidia's stock may have also suffered from the unveiling of a mildly competitive Google chip, too. But if you recall my interview with CEO Jensen Huang, he said he welcomed development and he would even help his customers develop them, and that includes Google. So I'm not shaken or stirred. But I understand. Nvidia can still fall, but, you know, I say own it, don't trade it. Let's consider another one of today's losers turned big winners, Enphase. Here's a solar company that's just been hammered mercilessly, down from $191 a year ago to $122 today. No news, just the usual dead cat bounce, pushing up nearly 6% today. Then back to the winners turned losers. How about Eli Lilly down $20? Why? The only news is good news. Lilly broke ground for a new $2.5 billion plant in Frankfurt, Germany to make Zepbound, their GLP-1 weight loss drug. Call me a buyer if the dust settles. Next, let's look at another loser-term winner for a day. FMC up 6%. I took it, I looked it up, and I see one of the most horrendous shortfalls of the year at the beginning of February when FMC said its first quarter earnings would be 21 to 43 cents. Wall Street was only looking for $1.01. I mean, that is really a shortfall. Calling it a shortfall is actually putting it lightly. That's a long fall. The stock was at 119 last year. It's now at 64. A bottom fisher's delight, but I'm not interested. I'd rather go fishing for flounder. Same goes for Lamb Weston, which bounced more than 3% today. Don't get all excited. This maker of French fries plunged from 101 to 77 yesterday in response to disappointing earnings last Thursday. A rebound back to 80 isn't all that stupendous. Fish and chips. How about two winners turn losers, though? Deckers and Eaton, down more than 2 and more than 3%, respectively. Deckers, which you may know as Uggs or Hoka, have been up 33% year-to-date as of last night's close, while Eaton, the maker of so many important electrical devices in the data center, is still up 30% for the year. The only news I found about Deckers was an incredibly positive read from the crucial Piper Sandler Teen Survey. More than 6,000 people polled, and Hoka was pretty much the star of the entire survey, with a 280 basis point increase in mind share versus last year. UGG was the #2 fashion brand among upper-income female teens. As for Eaton, it's my charitable trust's favorite industrial because it's involved in the reindustrialization and reshoring of so many industries, and it dominates the non-tech part of the data center. Finally, one more loser-term winner, Cisco, up almost 4%. Why? Because an analyst came out and said, buy the stock because it's underperformed. Prosecution rests. So what's all this action about? Simple. Today I got the tough call from my CFO, happy birthday, Noreen, that we have to pay more taxes than I thought. I'm not alone, especially because the government's taken surprisingly high this year. What a terrific time to take some profits and winning stocks to pay for the stock's gains. But if you own the losers, you've got no taxes to pay, so no tax-related selling pressure to speak of versus these winners, which have obviously drawn a big amount of selling. Now, we can't say that the losers now will be later to win, as Bob Dylan tells us. I think that's wrong. But the bottom line, the stocks that pulled back today have everything going for them, except that they've already run so much that they've become vulnerable. And today's winners, with the exception of Cisco, I say 3 words. Sold to you. Devin in New York. Devin.
Booyah, Mr. Cramer.
Well, there you go.
Respect to all you do, fresh out of college, and thank you for getting me ready for the real world, Mr. Cramer.
Oh, man, I'm glad. You sound like you're very ready and fired up, and I like that. How can I help you?
Yes, sir. So I just have a question about JPM, and given the growth that they've seen in the past couple of months, and with Jamie Dimon still strong at the helm, will JP Morgan continue to see the exceptional growth, or, as Jamie Dimon expects, will inflation and higher rates affect JP Morgan's growth negatively?
Well, I have to tell you, I think you said, Devin, you really hit the nail on the head, which is that Jamie may not want to tell us positive stories we like. He may be too conservative. So let's let the earnings speak for themselves. This company sells at 12 times earnings. That's, quite frankly, ridiculous. I think the numbers will be good. I don't know if the stock will react to it, but if it does come down on good numbers, then it's a buy. Today, it was astonishing how the great stocks of the moment mostly got pummeled while the subpar performers finally had their day in the sun. This won't last forever. On Mad Money tonight, Elf has more than doubled over the last year, and with the company continuing to dominate the makeup aisle, I'm learning more about what has brought the company to this point with the CEO. Then, looking for some small-cap tech stocks that have potential, I've identified a handful that I think could be worth watching. And cybersecurity continues to be one of the most important themes of this market, so I'm going straight to the source, the CEO of CrowdStrike. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.